Alright, bet. Welcome to part 6 of the Inception model. I hope you're doing well while watching this video. Today we're going to be taking a look at open, low, high, close, and open, high, low, close. Yet again, another ingredient to the entire model and just as important as every other one we have taken a look at. So, open, low, high, close, open, high, low, close. The formation of every candle follows this process. Bullish candles adhere to open, low, high, close. Bearish candles adhere to open, high, low, close. So it does not matter the interval. May it be a daily, 1 hour, 5 minute, 1 minute. Every candle that prints on the chart follows this process. And footnote on the bottom right, simply just clearing up the abbreviations. OLHC stands for open, low, high, close. OHLC stands for open, high, low, close. Now, before we take a look at the process for the formation of a candle, the anatomy of a candle should be understood first. Now, rather self-explanatory to be honest, but the schematic on the left being a bullish candle and the schematic on the right being a bearish candle. Bullish candles adhering to an open, low, high, close as we know. The bullish candle will open to then form its low, and then it's high and then close. Vice versa for the bearish candle, which adheres to an open, high, low, and then close. And footnote on the bottom right stating how indecisive candles can adhere to both open, low, high, close and open, high, low, close. And this is because indecisive candles can print in whatever manner they so desire to do so, but ultimately what makes a candle indecisive is that the close of the candle is near the opening of the candle, and we will take a look at this later on. But something I will say is that when it comes to the formation of a candle, you need to picture it as if you are building a Lego set. That is something to take a note of. When building a Lego set, the goal is to fix all the pieces to match the image on the box. The candle is the image on the box, and the pieces are the ingredients that we've been going over and more to come, such as the PD array matrix, delivery phases, interactive relationships, ranges, time, fib tools, all of the sorts. These are all pieces within the box in order to build the image, which is the candle. This is why if we are under the preconceived notion that these markets operate on an algorithm with a base set of rules and principles, when trying to build a candle, the framework has to make sense. It needs to be derived from sound logic. Away from that tangent and to now further investigate the anatomy of a candle. So each process that is utilized for the formation of a candle can be associated with a delivery phase. Delivery phases being part 2 of this series. So with each respective process, starting with the open, it can be connected with the delivery phase of consolidation. The close can also be connected with the delivery phase consolidation. The low and high process, however, can both be connected to the reversal and retracement delivery phase. Reason why being is because it ultimately depends what type of candle is being framed, which can only be one of three: bullish, bearish, or an indecisive candle. So to elaborate, here is a bit more of a descriptive schematic for an open, low, high, close. So you have your open, low, high, and then close. Schematic beside it showcasing how the open and the close being a consolidation, the low being a reversal, and the high being a retracement. Reason why the low is considered a reversal is because an open, low, high, close is being framed, being your bullish candle. Once the low forms, expansion is invited in order to create the bullish expansion. The high being a retracement as it is delivering back into the bullish expansion delivered from the low. Same goes for an open, high, low, close. You have your open, high, low, and then close. Schematic showcasing the open and the close being a consolidation, the high being the reversal, and the low being the retracement. Same logic as the bullish candle. The high being a reversal because it's inviting for the expansion to fulfill a bearish candle, and the low being a retracement because it's delivering back into the bearish expansion delivered from the high. Now, in regard to the Inception model, if we are framing either an open low high close or open high low close, we don't care for where the close is going to be for either of them. It's not our job to try and anticipate where a candle is going to close. It ultimately serves no purpose. What we do want to focus on would be the opening of the given candle. So for a bullish candle, our focus should primarily be placed on the opening and specifically under the opening of that candle in order to identify the formation of a low, anticipating for expansion to follow after. Vice versa, for a bearish candle, the focus should be placed on the opening, specifically above the opening, in order to identify the formation of a high, anticipating for that expansion to follow after. Because, like mentioned in the part of delivery phases, the model is designed to capture the expansion phase before it begins to unravel itself out in price, which ultimately means the phase before should be paid attention to. So now that we have an understanding of the anatomy of a candle and where our focus should be, which is below the open for a bullish candle and above the open for a bearish candle, it's now a case of where does a low or high form during the formation process of a candle. And again, under the preconceived notion that these markets are run under an algorithm, and if you're subscribed to this channel or you are watching this video, you are within that paradigm. With that knowledge in mind, it means that the formation of a high or low for a candle is not random. So the lows and highs of candles will form in PD arrays from the matrix and levels of a range. PD array matrix being part 3 of the series and ranges being part 4 of the series. Now, in relation to the PD array matrix, absolutely any PD array within the matrix. So if we are to take a look at the same previous schematic, bullish candle will open, form its low inside of a PD array that is within the matrix, and expansion follows after to form its high. Same goes for the bearish candle. Price opens, trades into a PD array within the matrix, which is then followed by expansion in order to form the candle low. And for ranges, it is basically the exact same. It's just the stuff that we pay attention to when observing a range. So we have this candle opening, delivering into what could be the equilibrium of a range, OTE of a range, lower quadrant or upper quadrant of a range. Same goes for the bearish candle. Price opens, trades into a respective range level, being one of these four, forms its high, and ultimately rolls over to expand, forming its low for the candle. Now, if we are anticipating the formation of a low or a high inside of these levels or a PD array, when price delivers into them, certain things need to occur in price to promote the idea that the low or the high has formed. Sensitivity in price action around a PD array or a range level. This is the gauging of order flow, which I have only touched lightly so far for now, but the way to imagine price action being sensitive to a level is as if it has an allergic reaction after engaging with that level, which will then spark a chain reaction in price. You then have cracking correlations, which I won't touch on too heavy as market maker models have to be introduced to the series. And then you have your CISD being a change in state in delivery in the formation of an order block or an inversion fair value gap. Now, sometimes when we're anticipating for that point of inception, we are framing an open low high close. Sometimes the formation of an order block would not be apparent on the time frame you may be looking at, and it may simply just be an inversion fair value gap. Or it can be the opposite way around in terms of there is no inversion fair value gap, but there is an order block. Now, this is everything that has been released for this series so far. And if I'm being honest, there is a bit more to how a high or low forms in price. The likes of time, the alignment of time, standard deviations, and all of the other sorts which come into play. But all of these parts will be released in a manner that allows for the bigger picture to be very much clear. So now we can jump into the charts and take a look at some examples. Now, like I mentioned at the very start of the video, it does not matter as to which interval we are framing an open, low, high, close. They're all going to adhere to the exact same process. But on the 15-minute chart, simply just going to do this 9:30 candle from the previous day, as it's an indecisive candle. So we're going to first take a look at an indecisive candle. So when we're just sitting on this 15-minute chart, observing this 15-minute candle, we have an open, high, low, and then you have your close. Now, where does the high end up forming? So of course you'd look to the left of the chart, or is referencing the left of the chart in order to dictate the right side of the chart. Now, depending on your knowledge of ICT concepts, one may not see a PD array that resides here. There's multiple things that this high ends up forming off of. For one, you have the low of this candle. So this would be your London low. It's engaging with a PD array. You also have this inversion fair value gap, but ultimately what it has engaged with would be a range. So the equilibrium of your range, we ended up seeing price action delivering up, engaging with it. It's not a case of you have to be paying attention to everything. It's simply just a case of paying attention to the right things, because again, it's an algorithm. These things are going to overlap. So we end up seeing this 9:30 candle delivering above the equilibrium and cracking correlation, equilibrium, cracking correlation, and then we had that deliverance down. So now we're just going to investigate this candle on lower time frames. Right now we have the open, high, low, and then the close anchored for this candle. So dropping down onto a 1-minute chart and observing this 15-minute candle, you have the open, high, low, and then you have its close coming in right here. So the candle opens, we deliver, engaging with this range level right here being your equilibrium, and there is also an equilibrium cracking correlation, and from that engagement with the equilibrium, this 9:30 candle ends up becoming an order block. So you have a series of up close candles, in this case just being one series of down close candles, and that would be the formation of an order block inviting for that sell side deliverance. So we end up seeing price action engaging with this order block. If we were to look to gauge order flow, the mean threshold is being respected, but price action is staying there for a rather long time. That is something that you generally don't like to see in terms of price action hanging around your PD array for a long time. Like I mentioned earlier, an allergic reaction. This isn't really much of an allergic reaction. The way I view this is, okay, we engage with the order block, we have the first reaction off of it, and price snaps down. However, we still close inside of it. And then it's as if price is like, hold on, let me try this again, let me try this again, let me try this again. And it just continuously stays here. It's not really the best of signs in terms, it's not a case of, oh, this idea is not going to hit and unravel itself out in price. It just may be a case that you're going to be sitting in conditions like this. Now, of course, there are other things that are in price here that indicate you are going to be sitting in these type of conditions. Yeah, this would be an indecisive candle right here. What we end up seeing is we follow an open, high, low, and then close. That is the formation this candle follows. However, an indecisive candle could also do something like this. So these are just some examples of how an indecisive candle can print in price. There's a multitude of ways, but like I mentioned, an indecisive candle, the close has to be relatively close to the opening, as well as the fact that the wicks are going to be a lot much larger than the bodies. So the wicks on both sides of the candle is going to be larger than the body. But we're now going to take a look at another example, and this time we're going to take a look at an example I engaged with. So this will be cherry picked, and then we're just going to do a random one. So this will be from this day's trading, and I'm just going to, and what we're going to be observing would be a 4-hour interval, open, low, high, close for this 1400 candle right here. So this 1400 candle, we end up seeing price action engaging with this imbalance that resides here. Again, depending on your knowledge when it comes to ICT concepts, this wick as well. We could also grade this wick. This wick serves as importance because it delivers into this imbalance. So we end up seeing price action utilizing the upper quadrant of that wick. Or if you simply just have the fair value gap still being graded out, so simply just going to mark out this candle for where the candle opens, closes, and forms its highs and lows. So here we have the open, low, high, and then your close. You can see that the high and the close relatively close to each other. This is just an indication that price action was rather eager to have that deliverance up. It was in a rush, as well as the fact that it just means that there was not much of a retracement for this candle right here. So now dropping down onto the 15-minute, same 1400 candle, you have your open, low, high, and then you have your close. So what we end up seeing is the PD rate that this 1400 candle uses would be this 15-minute order block right here. So this would be your 15-minute order block. Cracking correlations were establishing themselves in price during this segment of price action. If we were to add a standard deviation for the sake of adding one, we have that -2, -2.5 where the high ends up forming. But we can see that 1400 candle opens here, forms its low inside of this M15 PD array, and then it invites for that expansion. Now, on the 15-minute, you may not be able to see it, but consolidation is occurring here. This 1400 candle, the opening of it is consolidation. It's an indecisive candle. We know how price action looks for an indecisive candle. It's not even a requirement for us to go on to a lower time frame when seeing an indecisive candle to know that there was some sort of consolidation occurring. So if we are to just drop down to the 1 minute for the sake of doing so, a much closer look at this price action. Here you have that opening consolidation, delivers down into that M15 order block. This imbalance right here nested inside of this M15 order block, as well as the fact that there is a change in stay in delivery that resides right here. So I know that there was a internal cracking correlation that presented itself right here. And then you have that expansion above the opening. And then we consolidate around the opening for a little bit more time. This is simply just the accumulation of orders for price action to continue expanding. Now, this right here would be an example of an allergic reaction. Price action does not want to stay around this change in state, talk less this imbalance that resides right here. We end up seeing price engaging with it, simply just snapping away from it immediately. But yeah, that would be a cherry-picked example. Lastly, we're going to do a daily candle this time, and I'm just going to, oh shit. All right, but we're simply just going to do this candle that resides right here. So we just jumped on to a random bar, random date, and we're going to do this daily candle. So this right here is your daily bullish candle. Now, observing it just on the daily interval, can automatically see where the high ended up forming, being this imbalance right here. Not much of a retracement is actually offered in relation to range and price. I'm not sure what the framework looks like on lower time frames, but this is a bullish candle. Open, low, high, close. Right now, be looking to pay attention to the opening and everything under the opening. So we can see under the opening, price action delivered, engaged with this low right here. This would be a time-based range. This would be a daily range. Again, part 4 of the series, I'm pretty sure, being ranges. That would be your previous day low being engaged with. And this segment of price action right here, I feel inclined to say that there is potentially a cracking correlation, some sort of cracking correlation, inviting for this level of expansion. I'm not sure where. Yeah, so this would be the cracking correlation. ES engaging with the 27th of September NASDAQ failing to follow suit. So there's no second stage unless maybe YM, but I'm pretty sure, yeah, YM didn't offer that second stage. So we do have this cracking correlation right here. So not only are we engaging with the previous day low being Thursday's daily range low, we're also engaging with this rejection block right here. So simply just paying attention to the daily, this is what this open, low, high, close is based off of. Low-key, just remembered I'm supposed to be doing a bearish candle, but I'm low-key too deep in already, so might as well just continue. Yeah, so just paying attention to that daily, this is what this open, low, high, close is based off of. So dropping down onto the 1 hour, you have a clear open right here, consolidation of orders around it, and then you have the deliverance down, engaging with that Thursday low of day, as well as this daily rejection block, change in staying delivery, low formation has formed, and then you have that expansion towards buy side, the high forming inside of that daily imbalance. Now, depending on the type of trader you are, all depends on when you're going to get in on a move like this. If you're trading on, if you're not an intraday trader, you may be a day trader or a swing trader. It does not matter in terms of what type of trader you are. The way these markets are analyzed is the exact same. If you are an intraday trader engaging with sessions, you're in and out of sessions. This move is already done by the time you've seen it. Returning back down into this change in staying delivery is a completely new move. This segment of price action here is a move of itself. So if we were to drop down onto the 5-minute, what we end up having is, okay, we have that consolidation of orders, and then you have this deliverance down. Obviously, this being high impact news, this is manual intervention, so it's being utilized as manipulation. But when we engage with the daily rejection block off of the manual intervention, what ends up happening is we have the formation of an order block, price action being located just under it. We can also see how this daily rejection block is being utilized in a very sensitive manner when paying attention to this M5. Once we close back above this daily rejection block, when it's time for price action to be engaging with it, it's very sensitive. It engages with it, snaps away, comes back again, snaps away. We don't see any body candle closure. We also have to bear in mind that this is a daily rejection block, which is why time is being marked here. It's not a case of, oh, it's a 5-minute rejection block and time is being marked. If we're to compare it to a 5-minute PD array, this would be your 5-minute PD array. There is only one time mark on this 5-minute PD array, but in relation to this daily rejection block, there's not a lot of time being marked in relation to the daily. But away from that tangent, you have the formation of your order block right here, as well as an inversion fair value gap and your normal fair value gap that resides right here as well. So being an intraday trader, you'd be located right here. It's the exact same signatures that we see on the daily, or the 1 hour being that change in staying delivery. However, it's just being located a whole lot sooner. It's being located off of the engagement with that rejection block. If we were, okay, we can't go on to the 1 minute, thankfully, I guess, because I'd probably be here a lot longer. Yeah, that would quite literally be it in relation to this day's deliverance for its open, low, high, and then close. So that is all for this video on open, low, high, close and open, high, low, close. Thank you for watching and stay tuned for the next part of the series.